In March of 2010, the Jamaica Deposit Insurance Corporation, JDIC, staged the first Caribbean Bank Insolvency Conference at the Rose Hall Resort and Spa in Montego Bay. Over 20 experts from countries across the Caribbean, Canada, the United States and United Kingdom spoke on issues relevant to the global financial crisis, international initiatives towards best practices and resolutions for bank insolvency. Today, we highlight the presentation of the Governor of the Eastern Caribbean Central Bank, Sir Dwight Venner, who spoke on multi-jurisdiction regulatory governance, the case of the Eastern Caribbean Central Bank, ECCB. You'll also hear from the Inspector of Financial Institutions in Trinidad and Tobago, Mr. Hiralal. He will address the issue of the necessity for and challenges to a college of regulators in the supervision of financial conglomerates that operate cross-border and cross-sector. Sir Dwight Venner has been the Governor of the Eastern Caribbean Central Bank for 20 years. He's an experienced economist and has written and published extensively on subjects including public finance, political economy, and international economic relations.
The evolution as we see it today has again seen the dominance of foreign banks. The Canadian banks dominate the commercial banking sector, and FCIB, which is formerly Barclays and CIBC, has now been completely bought out by CIBC, and RBC has taken over RBTT. Canadian banking assets are more than 50% of the banking assets in our jurisdiction. The ECCB is, in a sense, a microcosm and precursor, or a template of, if you like, of what the Caribbean financial system might eventually be. It is a residual, of course, of the old arrangements, but by treaty, that is the OECS treaty, which deliberately writes in aspirations to having a single financial space through treaty, is the precursor, so to speak, of what is envisaged to be the CSME. It is a collaborative arrangement necessitating collective action in which sovereignty is pooled. And that, of course, overcomes a very significant issue with respect to multi-jurisdictional central banks. In fact, there are only 4 in the world, 4 effective ones, 2 in Africa, the European Central Bank, and ourselves. This pooling of sovereignty is a very delicate one, so to speak, because that has been an issue which has been an impediment, so to speak, to this kind of arrangement. The Europeans took many years to come to that position. The French territories, the French West African territories, virtually had it imposed on them. We, for our part, came to this system voluntarily. And while the European Central Bank is the part of a developed framework of countries and have their own mechanisms, the African system is still dependent on the French treasury. We have no one to depend on but ourselves. But the pooling of sovereignty has proved fundamental to our survival over time. And in this recent episode of financial crisis, increasingly so. Let me give you an example of what this means for us in terms of preservation of the stability of the currency. On 2 or 3 occasions, when parts of the arrangement, that is single countries, had financial and other difficulties and had to engage the International Monetary Fund, the fund, as it did in those days, insisted that the currency be depreciated, not realizing that this required a unanimous decision of all the member countries of the arrangement. And so those to whom that proposition was made simply said to them, This is not a decision we can take on our own. It requires a unanimous arrangement. And so they went around and could get no agreement and could report faithfully to the International Monetary Fund, but by law, this could not happen. And this is only because the sovereignty was pooled and shared. But in the case of other countries in the region, which did not have a fallback on other countries, this could not happen. And so we've had changes in a fundamental policy instrument, which is the exchange rate. The Monetary Council, which is the leading decision maker of this arrangement, has two dimensions. It comprises of ministers of finance, who as a collective can take decisions on very fundamental issues. These are called type 1 decisions that they can do themselves. But comprising, as it were, of financial ministers of finance, they also can act in their individual capacities in their own countries. And so one of the things that they have done in order to make the arrangement work is to have as a policy the making of uniform financial legislation for banks and all financial institutions, and particularly so those things that affect financial arrangements as a whole. In the new OECS treaty, which was initialed in December and which should go through parliaments by June, they've raised this to an even higher level, where the ability to pass legislation would have been ceded to the heads of government in the area of monetary policy and a few other areas. There is no doubt in our minds that we have to restructure the banking and insurance sectors. There's too much fragmentation. There are too many institutions, make it very difficult to regulate them effectively. We have over 100 insurance entities and 40 commercial banks because they are taken into account by jurisdiction. So the Royal Bank of Canada is 5 banks in 5 countries. That's it. So we really have to deal with that in a very structured way. The wider scope of regulation supervision in the ECCU has to take into account several concentric circles. They're concentric circles starting from the country, the currency union, the region, and Canada. Canada, because Canadian banks dominate the system, and we've had to have an arrangement with OSFI and how we're going to treat with those. I mean, if a Canadian bank fails, what do we do in our jurisdiction? We've had that discussion with OSFI. Internationally, standards and codes, Financial Stability Forum, the G20, and the OECD are things we all have to take into consideration. The Monetary Council has gone ahead and started to establish other subcommittees to deal with financial stability issues. There's a comprehensive regulatory and supervisory framework in the region on the basis that the Monetary Council and the board make decisions and the management of the bank. There's a regional oversight committee of all the regulators in the arrangement. There's a payments council. And what we've attempted to do is to ensure that the Ministries of Finance and the Attorney General's offices are involved in this process. But we've also encouraged sector association. Corporate governance is a very strong element of ours. And finally, public information and education are absolutely critical if the financial system is to reflect what is required in the society for its protection and stability.
Since 2007, Carl Hiralal has been the Inspector of Financial Institutions at the Central Bank of Trinidad and Tobago. He's an experienced financial regulator with over 27 years of supervisory experience. He has regulated and supervised over 400 financial institutions.
The primary objective of supervision and regulation of financial institutions is to mitigate undue losses to policyholders and depositors, not to prevent insolvencies. Regulators and boards of directors need to move away from focusing on solo analysis and quantitative analysis of financial statements. Instead, there needs to be a better balance between qualitative analysis of a company's governance and control systems and quantitative analysis of the financial metrics. But assessing a company's governance and control environment is a challenge by any environment, by any measure. Trying to do this for a conglomerate is even more trying. Supervisors are generally not trained to do this type of qualitative assessment, and this is a global phenomenon. In order to assess and identify weaknesses and deteriorating trends in financial institutions' governance and control environment, regulators need to have a different mix of skill sets. Technical competencies in auditing and accounting is no longer the answer. In fact, incorporating the assessment of governance, risk management, and controls as part of the regulatory framework requires a different mindset. This requires supervisors with broad business and operations background, as well as access to industry specialists with the right experience and expertise. Some regulators are actually relying more and more on a combination of in-house and external specialists to do the risk analysis and leaving their normal regulatory staff to do the ongoing relationship management and coordination role. Progressive regulators such as OSFI Canada and the Monetary Authority of Singapore are examples of regulators that have achieved significant success at early intervention. Generally across the world, this is an elusive goal. Indeed, financial institutions in Canada have been among those that were least affected by the recent international financial crisis. There are many reasons for this, including the fact that OSFI operates truly on an early intervention mandate. Most of us have a single mandate, that is prudential regulation. But some of us, many of us, have the additional responsibility for market conduct. We are dual regulators, prudential regulators and market conduct regulators. Regulators with a double mandate find themselves at a disadvantage vis-a-vis regulators who only have prudential responsibilities. It is not unusual for host regulators to focus a bit more on the market conduct activities and to leave the overall prudential monitoring to the home regulator. And certainly this has been the international experience. In this scenario, a college of regulators meeting becomes a one-way street. There are also challenges with companies that operate cross-border. Companies that operate in insurance, banking, and securities sometimes could have 3 different set of regulators to deal with, even in a single jurisdiction. Now consider the impact of that when these companies operate cross-border and you have to deal with multiple regulators in each jurisdiction. This is a logistic nightmare when you're dealing with large conglomerates that operate cross-sector and cross-border. Ladies and gentlemen, very quickly, we have already started a College of Regulators. We have already met. We have started College of Regulators, particularly on the banking side, not only locally and in the region, but also internationally with OSFI Canada. A successfully operating college should change the way national supervisors work, as it should give them more intimate understanding of the mind and management of the firm, and by extension, its risk profile. This should therefore facilitate early identification of weaknesses and deteriorating trends well before they show up in the financial statements. Ladies and gentlemen, the ultimate objective of all regulators is a fair deal for consumers, and an early intervention system and a college of regulators are essential tools for achieving this critical objective. Challenges exist, but I am confident they can be overcome. Thank you.
In our next episode, we'll feature the presentations of Associate Professor of Law at the University of Warwick, Dr. Dalvinder Singh, and Attorney General of Antigua and Barbuda, the Honourable Justin Simon.